Hi, I'm Jason Jessup, and I'm the CEO of Magna Mining. Magna is a Sudbury-focused nickel-copper PGM exploration development company with two significant assets here in Sudbury.
Good to see you again, Jason. I think we saw you back in August. Had a good session with yourself and Merlin. Got into the weeds a bit. Now, three key takeaways there were continued exploration program this year. Quite a big program. So update on tolling and how you're going to kind of solve that or approach that. And I guess the third aspect is the combined economic study, etc. So let's start, if you don't mind, with the where are you at? What have you been up to since August?
Yeah, so we've been really busy. We expanded the team. We added a COO, Jeff Huffman, who is a Sudbury local. He was the president of Dumas Mining. So it's great to have him as part of the team. He was also a colleague at FNX Mining here in Sudbury in the past. We've really been focusing on a few things. Of course, exploration, which is a big part of our story, and we think it is, we're in one of the best locations to make big nickel, copper, PGM discoveries. So exploration has been ongoing. I can talk a little more about that in a minute. We've also been looking at our PEA, and the PEA that we came out with, as we talked about in the summer, was really to understand how much of our 31 million ton resource could be potentially mined. And so we used a lower cutoff grade to see how much of that could actually be mined. And we were quite impressed by the tons in the life of mine potential from our project. But it did not include any of the drilling that we did last year. So we've been now updating our wireframes based on the approximately 19,000 meters of drilling that we did in 2023 at Crean Hill. And we will be updating that resource in the first half of this year. We've also started looking at, mining plans at higher cutoff grades. And just to kind of reference the resource that we came out with had 14.5 million tons at 1.1% nickel equivalent cutoff. We use an NSR cutoff for our PEA, but it kind of equates to about a 0.78% nickel equivalent cutoff. So, the 14.5 million tons we had in our resource at over 2% nickel equivalent isn't really reflective of the PEA. So we're looking at higher cutoff grades, lower tonnage, higher grade. And this really fits well into our plan to get into advanced exploration and sell ore to one of the existing mills here in Sudbury. So exploration is a big focus, optimizing our mine plan and looking at the new resource and how that could play into that. That's really what we've been working on.
So again, for people who perhaps need a story, can you remind me with Shakespeare, you bolted on Crean Hill, which obviously made the numbers look super impressive. But did the PEA kind of cover how you get at both of those projects, or if you get at both those projects? I mean, what was the actual initial focus in your mind about how this thing gets built out?
Yeah, so the scope of the PEA in the base case was simply Crean Hill, life of mine processing through one of the existing mills here in Sudbury. And in section 24, we had an alternative processing scenario. So just to test and to determine whether it was worthwhile to do another technical study to combine the two projects, we just ran the numbers looking at if we were to truck ore to a future mill at Shakespeare and use the same processing costs that we had in the feasibility study for Shakespeare in 2022, what would that look like? How would that change the economics of Crean Hill? And it did have a very positive impact, adding about an extra $280 million NPV. So that gave us some evidence that, it's worth exploring in a technical study how we could combine those two projects. So as I mentioned, right now what we're looking at doing in our focus over the next 2 years is to work on getting advanced exploration started, start shipping ore, and our closure plan that we've amended, we filed, and we hope to have all completed and approved in the coming weeks, outlines 400,000 tons that would be part of our advanced exploration. So that would be the initial start of mining and of testing some of these zones at Crean Hill. And then we'll do a study to determine whether it's feasible to put the projects together into a future hub and spoke, but that's a little further down the road.
Right. So it's just really because you got to manage your money. Like, where are you? I'm not quite sure you were out of the right. So under 70 million market cap at the moment. Like I say, I don't think Nickel got a fair hearing last year, and we'll probably, hopefully, if you don't mind, kind of get into it in a little bit, maybe some of the causes for that. But sub $100 million company trying to fund stuff like this is hard, and you've got to navigate a path forward with the assets you've got available to you and the cash you're able to raise to do that. So Crean Hill on its own, and I know when we talked, you talked about anything above 10 million tons would be good at 14. Good news, but and high grade, etc. How do you maximize the chances of success in terms of getting that first project over the line and getting into some cash flow at the nearest possible opportunity?
You're absolutely right, Matt. You have to manage your cash, and that is so critical in these markets. We were fortunate last January, just over a year ago, to raise $18 million, and just in 2022, we raised $20 million to acquire Lawman. So we ended September 30th with $15.5 million in the bank. That's going to fund, with the money we have this year, fully fund a 25,000 meter drill program. And we think that is the greatest catalyst, or the greatest potential catalyst to drive our share price higher. But we do not need to raise any more money to continue the permitting and de-risking Crean Hill. Internally, we have a team that can look at optimizing that advanced exploration with the updated drilling we have from 2023. So that's being done in-house, very low cost. And basically, we want to have everything in place, ready to pull the trigger on advanced exploration later this year, or potentially even next year if the markets stay tough. But we do not plan on going out and doing a big equity raise. And by big, I mean $20 or $30 million in these markets. That makes no sense. Now, we will look at other options to fund advanced exploration, which could include government grants. And there are a number of grants out there that we're applying for, as well as potentially, non-dilutive sources of financing, such as potentially a gold or a cobalt stream, which is one of the byproducts that we have in our project. But we're going to focus on exploration, which the cash we have, and we're going to spend approximately $8 million this year on exploration as we continue to de-risk and have the advanced exploration ready to go. And when the cost of capital is right, that's when we'll pull the trigger.
Right. Okay. So I suppose is the key, as far as you're concerned, whether that be new discoveries or extending the resource profile. It is, it's obviously super high grade for nickel. And I like, as you say, a bunch of byproducts in there. Was it copper as well as the gold and cobalt?
Yeah, there's a lot of copper in the project. Yeah. It's almost 1-to-1, slightly higher in nickel.
Is that right? Wow. Okay. Interesting. But it does have this kind of, I guess, overlay perception, despite being high grade, and even if you do ore sorting and in terms of obviously reducing the amount of ore you shove onto a truck, to get told. People are looking at the size, not necessarily the economics. So is it your intention, or it sounds like it's your intention, to demonstrate that it is capable of growing bigger and that the economics can get bigger, because you need to before you can finance a CapEx raise at the point you need to? How do people view you?
It's a big resource already. When you look at nickel sulfide type resources, we have 31 million tons right now. So if you look at a production rate of 3,000 tons a day, which is a good size underground mine, that's 1 million tons a year. So there's potential to have a very long life at a very good production rate, producing a significant amount of nickel and concentrate, or nickel and ore that's being sold to a mill. So we definitely think there's potential to grow. But Crean Hill historically, when it was operated by Inco, was a tier 1 mine. It operated and produced over 20 million tons. A lot of those years it was producing in the range of 3,800 tons a day. So large production. And we still have a lot of ore right at surface. And the type of CapEx we're talking is not enormous CapEx. In the PEA with the large scale production, and in the PEA, it envisioned up to 4,000 tons a day, which is, in the range of what it was historically. You're only looking at $48 million of upfront capital for advanced X, and in total, another approximately $81 million to get it into full commercial production. So when you look at those numbers, and those numbers will change, but those are not $1 billion capex. They're not, a $500 million capex. They are, in line for a company our size, even today, which has come off a lot in this nickel market, a very manageable type capex for us to move forward. So we are not in a position where we think, we need to double the resource or we need to make a new discovery for it to be, potentially economic deposit. We think we have what's needed. That being said, we are extremely excited about the exploration potential. And we put out a news release last week that just sort of highlighted what we're working on. And we do think, much like in the past when many of our team worked at FNX, we can make a footwall discovery that can be extremely highly valuable rock and really, enhance the project even further.
Right. Okay. Which is pretty brave, right? Because, given the year you've had in 2023 and all nickel companies have had in 2023, just drilling did not get rewarded, it seems. So can you be clear with me the economics status now with the tonnage that you've got now? And if you could double that, what does that, how do you imagine, does that change, the profile of the company going forward? Because what I'm trying to understand is drilling the best use of capital? And if it is, tell me why.
So I do believe that true discovery will get rewarded even in these tough markets because it is rare. Our team has made true discoveries before and added a tremendous amount of value to those companies in the past. So we do believe that it is a good use of capital, and it is something that we think after our drilling program last year, we were able to understand not just our contact portion of the deposit, but our 101 and 109 footwall zones. And these are very, very crucial to our long-term strategy of making discoveries. So understanding the structures that are controlling these different zones going out into the footwall, now we are able to drill the deep holes we need as geophysical platform holes in the right locations where we believe a discovery can be made. We've drilled those holes. Our interpretation was correct. We've identified the right rock types, which are the Sudbury breccias, as we interpret it, where we interpret it. We've done the geophysics. We've had responses. And now we're in the process of testing those responses. That is exactly how, in the past, Gord Morrison, Dave King, who, Dave's our SVP and Gord's one of our senior advisors, and both of them were with the FNX exploration team that discovered the Levack footwall, which became the flagship of FNX, the Podolsky 2000 deposit, the Victoria deposit, which right now in Sudbury, KGHM is sinking a shaft on and going to be putting into production. So we're using all that experience. So we think that, yes, exploration and discovery can be rewarded. And I think we're onto the right kind of target that the market will care about, even in this tough market.
Right. Okay. And let's look at the kind of strategy to deliver that. Okay. Crean Hill focus, Shakespeare could be bolted on to that, and then a processing plant if all of the above happens efficiently, economically, and all the rest of it. In the meantime, there's a kind of stepping stone approach to this, which is, and part of that is the tolling. So you've had some permission to obviously take some or do some testing and do some bulk sales there. Well, tell me, in fact, update me. Tell me where you're at with all of that in terms of trying to get the toll agreement in place.
To step back away from that just a little bit. So as part of what we need to actually start drilling, blasting, and trucking ore off site, we need an amendment to our closure plan, and that Crean Hill already has a closure plan because it is a brownfield site. Technically, it's in a state of closure. We amended that for what we want to do, which is take a sample on surface, drive a portal from surface, a new ramp down underground, and start mining ore, as I said, 400,000 tons to get started. And those amendments are been submitted, been reviewed, and again, we expect to have that filed and approved within weeks. Then we need a permit to take water, to dewater the mine. That was submitted last summer. The water would be treated through an existing water treatment plant and discharged through an approved discharge point that Vale currently operates. So that permit was reviewed. In October, we got some comments back. We addressed those comments. So now we expect to have that, before the end of Q2 that allows us to dewater. Now, the third component, that's really all we need from a permitting perspective. It's very straightforward because it is a past producing site. The other thing we need is an ore selling agreement. So it's not actually toll milling, it's ore selling. And so that means we don't actually get the concentrate back. We sell the ore, it gets processed, and we get paid for the metal. And that is a great system because the way it works is the ore gets blended with existing ores. We have an equation that is basically based on the grades we send. This is what we get paid. And it is quite, we haven't released it yet, but the test work has been quite good. And we're really pleased with that. So those agreements are, in the sort of final stages of definitive. So we will hopefully announce that before the end of this quarter. And really that's all we need is those three things to start advanced exploration, shipping ore, and receiving revenues.
Right. And just on average, I appreciate you're going to come out by the end of the first quarter and talk about the specifics, but so just generally, so if I look at the uranium space, if someone's tolling, I'm going to stick with the phrase tolling for now, the processing plant will take 50%, right? They may either buy the ore completely and they'll pick a price, or roughly it's about 50%. For something like you're trying to do, what do you think the payables would be or could be on average?
So I'm not going to just say too much at this point yet, but what I can tell you is there is a lot of competition right now for third-party feeds in both of the mills. So Vale has a mill in Sudbury, the Clarabelle mill. It's a large mill, 16,000 tons a day. It is nowhere near capacity. So they are very keen to take feed. As well, Glencore has their Strathcona mill, which is very similar process, both standard flotation, Sudbury ores, and it does have a lot of capacity as well. So with our agreement we have with Lonmin, we can sell our ore to any mill that we want. Now, obviously, we have a relationship with Vale as this being a past producing mine, but it's a competitive process. We will, sell our ore where it makes the most sense. So it does give us an advantage, and there is an appetite for third-party ores. So we feel like we will get a very good deal. It will be a deal that will make the mine, I think, viable long-term, potentially. So, it could incentivize us to postpone the construction of Shakespeare if the economics from Crean Hill look good enough. And really, does Sudbury need a third mill? Probably not. But, we do have that option if we need to. And it is something we will explore in future technical studies. But right now, our focus is to move forward and to sell ore. And again, have a very low capex to get to a point where we could be cash flowing.
Right. Okay. And it's kind of interesting, kind of the deferring the kind of capex on a processing plant of some description, as long as there's competitive tension in the district for plants which are needing feed. It does, and if you're looking, you've been in this game a long time. If you're looking at an operation like yours, is this something that just runs? Is this remotely attractive to a Glencore, to a Vale, in terms of something that could top up their current plants? What's the exit, I guess, is what I'm like.
Well, I think the exit is not necessarily a Vale or a Glencore. There's certain challenges that Vale and Glencore have. They have, large structures as far as the way they're organized corporately and at their mines. They have a workforce that is a very highly skilled workforce, very experienced, but they've also had many collective bargaining agreements with their unions, and with that comes a lot of additional costs. I think that the majors like Glencore and Vale here in Sudbury look at us as an option for certain deposits that maybe don't make sense to them to be processed, where they end up with the metal units, which ultimately is what they both need. They need the metal units to fulfill contracts and for growth. They don't necessarily need to mine the deposits. Now, what I think makes us very unique, and in the future, the reason why we will be acquired someday, we have a lot of growth to do before we consider that. But in the future is we do have the ability to build a mill at Shakespeare and produce our own concentrates, where we would own currently 100% of that offtake. So if a mid-tier or another major wanted to have a footprint in a world-class mining camp like Sudbury, Magna would be that stepping stone to get in, where they could have, currently what we have is over 50 million tons of indicated resource that could be processed through a future mill with a relatively low capex. Our feasibility study from 2022 estimated the Shakespeare capital costs at $233 million. So for a mid-tier or major, very low cost entry point to start producing nickel and copper concentrates. So I think that is a very key point, and a reason why Magna may be taken out in the future.
Right. Okay. And just looking back on what you'd be shipping, ore sorting, I kind of mentioned it earlier. I mean, is that something else that you're looking at? Because I'm not, I'd love you to kind of explain in terms of how your ore gets blended with other ores, and therefore perhaps they would have a view on how much ore sorting, because you want to reduce the trucking costs, obviously, but at the same time, it may not suit the other party's needs.
Yeah, ore sorting is a really interesting technology, and it is something that we're looking into, and we've done some preliminary test work on, and we see that especially our contact ores, our primary sulfide ores, make up over 80% of our current resource, would respond very well to ore sorting. And it is something that could help reduce trucking costs. It could help reduce also the milling cost, that processing cost. The more metal you're sending in every ton of ore, there's definitely a benefit to that. So it is something we're looking at right now, because generally when we look at a higher cutoff grade, similar to what we had in our resource estimate, so a 1.1% nickel equivalent type grades, it is high enough grade. You don't necessarily need to do that. But I think what it does do is it allows us to continue to mine more mineralization, especially when there's adjacent stopes to what we would mine that are lower grade. And it's almost opportunity ore that can be run through an ore sorter and upgraded, and that could extend the mine life. But currently we're just doing those studies. It's not something that we need, but it is an interesting technology.
Right. Okay. Because ore sorters themselves aren't exactly, well, not too expensive, are they?
So yeah, there's one mine in Sudbury that's using ore sorting right now, and we've looked at it. We've toured the site. We have a pretty good understanding of the operating costs, and the capital costs aren't huge. So it is a nice potential bolt-on once we get up and running.
Okay, fine. Right, let's go back to share price 2023 nickel. I think the general consensus from retail looking in, and so therefore it must be true, is that Indonesia is going to supply all the nickel that we need. And what's the point of even trying out here in the West? How do you feel about
that? Yeah, it is it's interesting times for nickel, and how quickly things can change. And, it's you see all kinds of headlines right now about how much nickel will be produced in Indonesia and what that's going to mean. And it is reminiscent of other times in the nickel market. I've been in this business and really living in Sudbury, working most of my career in the nickel business. I remember back in 2001, I was working at Inco at the time, and nickel got down to $1.76. And I remember having a meeting at the mine where we were telling workers that, if nickel hits $1.60, we're laying off. And, and everyone thought it was going to $1.50, bad times. And then it rebounded quickly and it was over, $2.50 in no time. 2008, after the financial crisis, nickel dropped down below $4, and doom and gloom. It was the end of the world. Equity prices went along, to the tanks too. And then in 2009, a huge rebound, which was great. But more recently, back in 2017, I remember going out to, look at nickel projects. And that's when Magna acquired the Shakespeare project, was in February of 2017, when nickel was right around $4 again. And we went out, we bought Ursa Major, acquired Shakespeare at that time when everyone was, turned off by nickel. And I remember going out and marketing. After we closed that deal, we owned the asset. It had permits for a 4,500 ton per day open pit mine mill and tailing storage facility, had a historic resource, had a lot of good technical work done in de-risking. In Sudbury, we were raising money at a $1 million valuation, at next to nothing. And I remember people telling me nickel will never go ever above $5. There's too much nickel coming out of Indonesia, and it will always flood the market. It will never go above $5. to me, that was a sign that we were onto something here. And that's why we could acquire Shakespeare at that time, right? And you wouldn't acquire it even now. So I think we're sort of in one of those low periods right now. There seems to be some support for nickel at around $7. We're starting to hear news of, mines in Australia that are going to go on to care and maintenance, some of the higher cost operations. But there are so many macro forces at work, and I'm not going to claim to understand how they all interact together and predict, exactly what's going to happen. But just yesterday, I was reading that, Nornickel is giving out new guidance, and they're going to reduce their forecast of nickel in 2024 by 10 to 12%. Last year, they were 5% lower. They're one of the major nickel producers, especially from sulfide nickel. So there's a lot of factors at work. I think people are overly negative right now. And just like they were in 2017, this could be a bottom. Now, is it going to last for 6 months, 9 months, 12 months? I can't tell you. But what I can tell you is nickel will be at over $10 again. And, and I think the good companies are going to be strong coming out of that.
Well, okay. Well, maybe I won't get too much into the macro there, but you're now sitting as a kind of meaningfully large institutional component to your share register. For a small company, that's pretty impressive. I mean, can I just be clear about how you term institutional versus retail? How much they need to deploy, or how do you define them?
Yeah, so institutional is really, funds, and we have some major funds on our registry. Some of the big mining funds that, I think we're quite fortunate that they look at our company to do their due diligence, and they see a real company with a real business plan. So yeah, the ones we have in there now, of course, in our institutional investors includes Dundee Corp, which owns, just over 20% and led by Jonathan Goodman, who is on our board. But we also have some other big funds in there, and some of the typical ones that you would expect to see in a mining name.
Right, but they continue to hold through this kind of difficult period. There was no sort of offloading. They understand the thesis for nickel. I mean, nickel, we need to be clear again, for people new to this, nickel is 90% of it goes into the stainless steel market. So it's not all about electric cars and future predictions for electric cars. Even, mind you, even so, I think they were up 43% across last year. So I don't think even the electric vehicle story of their demise is unfortunately not quite true. But nickel markets, for us, your institutional shareholders is an area that they want to be in and they want to continue to be in.
Absolutely, and we try to reach out regularly to our big institutional investors and keep them updated on what we're doing. And what the feedback we've been hearing is, they believe in what we're doing, they understand, they're supportive, and we're starting to hear where there's interest at these levels to put more money, to deploy more money, when and where available. So we do think that it is it's still a commodity that at least the institutional investors that have invested in us are looking at. And I think that, they have sort of seen interest in value at these levels again, despite sort of the sentiment.
Right. Okay. Well, look, Jason, good to catch up. Nice to see the project advancing. Nice to say, you're good for cash for this year to kind of focus on what you think is important, which is the exploration component here. I will look forward to hearing updates on the rest of it as well. So stay in touch, okay?
Absolutely, Matt. It's great talking to you.